BlackRock, the world's largest money manager, just out with quarterly numbers moments ago. Earnings of $6.61 per share. Now, that beat the consensus estimate of $6.13. Revenue was in line with Wall Street forecasts, and BlackRock also increased its quarterly dividend by 5% to $3.30 per share. Larry Fink is with us, chairman and CEO, and he joins us now exclusively. The stock didn't look like it was moving in the pre-market on that news, but it does seem like it was in line. Given the headwinds of 2018, 2019 is a better situation.
Well, you're right, Andrew. Last year, global equities were down 13%. Global equities came back about 11% throughout the quarter. And so absolutely the circumstances are quite different. We grew our total asset base by 9%. So we grew over $525 billion in assets. $65 billion was organic, the rest of it was market movement. And so we're back over $6.5 trillion. But the mix of AUM was quite extraordinary. We had $80 billion of inflows in fixed income. So you saw many people putting money to work in fixed income. But global equities, you saw as an industry, huge outflows. So the trends have not really changed. But for us, we had, as I said, $65 billion in net inflows. We saw extraordinary new wins in our technology business. We had a record quarter of raising $6 billion of illiquid alternatives in the quarter. Right. And so we saw money being put to work, but I would not say investors were just jumping in all in. And the marketplace, with the market rally as large as it is, I would clearly tell you at this moment, the most investors are exposed by being underinvested at this time.
So you think they're under? Okay, so two questions. One is, to the extent you're pulling new money in, where are you pulling the new money in from?
I would say the one thing I could talk about with a little more public is our iShares franchise, where we had $32 billion of inflows, and it was pretty concentrated in Europe and the U.S. About $17 billion in the U.S. and $15 billion in Europe. Very little out of Asia in the first quarter. But in our institutional business, we saw it from Asia, we saw it from the Middle East. So we're seeing some money to be put to work, money from cash to fixed income. We're not seeing money being put to work rushing into equities.
What are the trends that you're seeing in terms of flows into the core iShares versus the mutual funds, to give us an idea of your fees and some pressure on fees?
Well, for the quarter, our fees actually went up 0.2 of a basis point. So we went from 18 average basis points to 18.2. So overall, I'm talking about the whole franchise. The whole franchise, and some of that is because we're now winning more and more in the alt space. So that's certainly helping. And we did see a reversal of 2018 in high yield. In the iShares business, it was a pretty good mix of both core, which is a lower fee, versus the non-core, which is more institutional and more for liquid markets, where we have options associated with some of those ETFs. And so we have not seen any real pressure in terms of a huge shift into only core. So we're seeing a pretty good mixture of both core and non-core.
You just commented before you answered that question that you believe people were underinvested.
Globally, yeah.
Globally.
Yeah.
But make the case why you think that. And are you saying that in terms of the equity market, or are you saying that just broadly?
Broadly, and some people are going to continue.
Is that a market call?
That is a market call, yes. If that's what you're asking for, yes. I think we have a risk of a melt up, not a meltdown here. Despite where the markets are in equities, we have not seen money being put to work. We have record amounts of money in cash. We still see outflows in retail in equities. We still see outflows institutional. I'm talking about an industry now. And so, and when we have something that's unique or special, whether it's in our infrastructure business or something else, the demand for these assets are extraordinary. So, and in fact, we have clients almost arguing with us, they want a bigger allocation.
But explain why you're bullish, because you've come on this program many a times when you have been bearish or at least lukewarm on where things are.
And it's just because I think we're struggling in this time, especially now with central banks, who are, if anything, more dovish than ever. They're not changing their behaviors related to QE anymore. There is a shortage of good assets.
We've had a couple of people in recent weeks, like Katie Stockton.
Yep.
We had someone else recently that said that this huge move from January to March has been met with very little excitement by investors. And you've got you would know with trillions of dollars under management, and you're not seeing in previous tops, you've probably seen a lot more excitement, haven't you?
Right. Well, we're seeing huge excitement in fixed income. So many, Well, many people thought we were going to be in a period of rising rates.
Right.
We were not, and
Didn't happen.
we saw huge underinvestment, and people had to rush in to invest in fixed income. We have not seen that in equities. That's what I'm trying to say. We have not seen what I would say that I missed that, and I'm running in.
Can I ask you about this? What I've been thinking about is sort of an enthusiasm gap, and we've been talking about Lyft and this sort of series of IPOs. You got Pinterest this week, and obviously Uber is coming out later. How do you think investors are thinking about that? Or do you think about the IPOs in the context of this enthusiasm issue or enthusiasm gap?
I think everybody's looking for a new story. And so when you have these IPOs, it's a new story. And those who are not investing in the private markets of equities, in the venture capital, or in the angel investing, or they're for the first time able to see these stocks. Some of them are big retail names now, like Uber.
But what is the Larry Fink view of this vintage of IPOs?
It really depends on what type of, it depends on their business models. We happen to be actually a large investor in Uber from the early days, and so we're obviously anxiously watching how it's going to trade.
Does the response to the way Lyft is trading make you anxious?
No, not at all. I mean, I'm not focusing on one stock or another.
Anxious.
Well,
no, but I'm not. But we shouldn't focus on one company.
No, but to the extent that Lyft would be a proxy for Uber, if you think it is at all. I mean, some people say that they're completely different businesses given the mix of things that they're doing, the international scope of what Uber's trying to do relative to a Lyft. But I was just thinking to myself, if you look at where Lyft is today.
But if I could make why those companies are important and translate that back to asset managers, because we just finished a leadership retreat where I spoke to all of our leaders related to the macro trends that are impacting our clients. So our clients all want more transparency.
Right.
Everybody is looking for a company that provides them more convenience. Okay, those are the two macro trends that are affecting, from taxis to purchasing on the internet, anything you're talking about. In financial services, most companies are not providing transparency and certainly not providing convenience. So I believe those are the two key elements that are changing the asset management and the investing market. And that's translating into lower fees. That's translating into still a great demand for higher returns if you could get it. But more importantly, it's translating in, I want you to focus on my outcome.
Right.
And so I asked all of BlackRock's leaders, those 5 trends, how is your business going to be impacted? And I actually believe we're going to see huge changes in our industry, huge changes in financial services, like we saw in the taxi business or retailing. People need and expect more transparency. Society's expecting more of that, and people want much more convenience. And we got to translate that into the asset management.
He's concerned. He's watchful. He's wary. But you don't get anxious. When's the last time you were anxious? Maybe when you started Black. You haven't been anxious in years, have you? You're not.
I'm not an anxious person.
You're not anxious. You got trillions of dollars. It's not.
Well, no, it's not my money, Joe, as you know.
So you are anxious about other people. OPM. Let me mention
I'm concerned.
Concerned, wary, watchful. I would even call you. I mean, it's more than calm. I would even say serene. You just have a presence. You just have a serene presence. And in addition to that, over time, you are, I would say, one of the people that speaks their mind about the conscience of Wall Street and capitalism and business in America. And last time you were on, I just thought it was kind of interesting when we were talking about Khashoggi and that situation with Saudi Arabia. I asked you flat out, would you end doing business with Saudi Arabia? And you said, no. Absolutely not. And you were very honest about it. And here we are with a bond offering where everyone basically came around, I think, to your point of view, and I didn't see anyone say, no, I'm not going to take any of these fees for the bond business or participate in the offering. So once again, common sense, it's the real world, right? I mean, there are certain things you have to just sort of hold your nose and move forward.
Well, I wouldn't even say you have to hold your nose. As I said, I think when we spoke about Saudi Arabia, we do a lot of work there. We manage money for the Social Security Fund. We manage money for many fine people in Saudi Arabia. We still don't know the conclusion of the awful tragedy. Obviously, a lot of fingers are being pointed, but when I write in my CEO letters, I talk about you have to be local in every community you work in, and there is not any community in the world that is perfect. There are many extremes in every community. But in every community, you need to be working with the local community to be part of that community. And that's why we concluded we're going to continue to do business there. We did not go to that one conference. I've been back to Saudi since. I will be going there shortly again, among many other countries I'm traveling to. And so, you have to be deliberate, you have to be open, you have to be forthcoming. But I do believe what we are doing in Saudi does not go against what we talk about in trying to have corporate purpose.
No, I agree. And China, you're there a lot too. I mean, things aren't perfect in China.
And they're not perfect in most countries. There are extremes in many countries. And our job is to try to navigate around that, but also to have a conscience too. So I'm not here to suggest we are not evolving and changing, because we all are. Because I do believe society is now asking more and more.
But so here's the question: for companies to be a forcing mechanism, if you will, on some of these issues, how does BlackRock think about itself in that context, in a place like Saudi Arabia or in China? Is it so much around navigating around these issues, or is it around acting as a forcing mechanism in a place like Saudi by to the extent you're to the extent you're going to do business there, to somehow using your voice there to say to them, look, we're going to do business with you, but under these conditions, or we're going to do whatever it is.
In every community we work at, in Saudi or China or the U.S. or Mexico or anywhere else in Europe, we have to stand by our clients in those communities, and we have to be working with those clients in those communities. If you're truly going to be an international company and have businesses throughout the world, you cannot impart, let's say, U.S. or whatever. You have to try to find ways of working within the community and try to help that community change. There are things that we have global principles that we're not changing. One of the global principles we are working towards having at least 50% women, so gender neutrality worldwide. Compensation is the same between women and men. Doesn't matter where we operate. So we as a firm are trying to evolve and change and move forward, and we're trying to be a principled organization working with all the communities we want. In countries where there are issues, I don't want to name any one company, I've had private conversations about what we think they need to do to move forward. And they can or they may or may not listen to us, but we do have voice our concerns. But I think the fundamental issue is society is changing. And I wrote this in my last letter. Millennials are asking more of companies they do business with. Millennials are focusing on where they work. And so if you're going to be a company that is trying to attract the finest talent, a company that is reaching more and more of society, you have to be more mindful. And I do believe we're in a very deep political debate right now, and I do believe the role of public companies is going to become larger and larger. And I do believe the leaders of public companies with their boards are going to have a stronger voice. And I do believe that stronger voice will lead to stronger profits.
Does that mean that you take the stand, or does that mean that you vote with your shares and take a stand?
It could be either. But BlackRock is standing up and taking, I have representing BlackRock employees, BlackRock clients, BlackRock all our stakeholders, our shareholders, we have a louder voice. We are also asking other CEOs, other chairs, other boards to have a louder voice. I do believe we have to be mindful, and you're hearing this from Jamie Dimon, you're hearing this from Ray Dalio, you're hearing from many people now, that there is a need for, I would say, more conscious capitalism. There is a need for more inclusive capitalism. And I said in my last 2 letters, society is frustrated the government's doing less for them.
Let me ask you a question real quick on that, though, because you saw Jamie Dimon was asked about it at the bank hearings last week about wages. You saw Jeff Bezos come out last week and sort of throw down the gauntlet on wages to Walmart. If all of these companies increase wages at the expense of their profits, at least in the short term, how does a BlackRock think about that? It may be good for society, but maybe bad for the stock.
But in the long run, if you're able to attract better employees and have more productivity, I mean, I can't answer the question with a limited information, but if they believe they are raising wages and are able to attract better employees, or employees, the same employees, but are now willing to work a little harder, they're more involved. If the output is better productivity, it may not deteriorate their margins. But once again, if you do that also, and if you raise the consciousness of your clients, and that produces more demand on your products, that may all turn out fine. So the question is, if you are just raising wages with the idea that it's not going to have any impact on your employees, not any impact on your...
These are private companies doing it. If you all of a sudden legislate in Seattle that you're going to $20 and suddenly businesses leave, it could be bad for society. It's not always just good for society that happens. It could be bad for the company.
The society where they are.
What's bad for companies aren't always good for society, Andrew. And it could be bad for society if there was a nationwide minimum wage of $20 could be actually.
But I would say very loudly, over the long run, having more engaged employees, stronger client connections.
These are private companies.
Larry,
thank you so much for being here. Appreciate it.